for lithium-ion battery. Stocks up 6%. That's a big move coming through. So that could be actually to begin with in terms of stocks with news flow, the stock to watch out for. Two other names. Maybe look at Craftsman. I saw Craftsman, which is entered an agreement to acquire another company. It's up 2.5–3%. It's a well-run South-based company, but there are no volumes there at all. So maybe give it some time. Sansera Engineering, a small name, but you got to initiations all around, right? Spark, which is Avendus now, they've initiated coverage on the Sansera. It's starting 5% higher. Volumes are low, but not Spark, but Spark has initiated coverage on Sansera. So 5% there, 13,000 shares is what the pre-open showed us. And I saw an initiation of JSW Infra as well. So we'll kind of track that as well. The market opening coming up on your screens, and what do we have? 23,580 on the Nifty, 77,510 on the Sensex. So these are first rate, is a good start. 50 points after yesterday's 50-point high close. The Sensex is up 170 points, and I think you've got the Nifty Bank, which is starting. It'll come up on your screen. We'll see if there is any sort of movement. Yeah, there is. Last hour yesterday showed some signs of life. 100 points, about 0.25%. Last week was good. Keep an eye out on some of the private banks and PSU names as well. IT index is absolutely flat. And maybe just look at the mid and small cap part of the market. I'll give you a sense. Small cap index didn't do very much yesterday. But the mid cap index was up about 0.4. I think the small cap index is starting absolutely flat. The mid cap index is up 0.25% once again. So it's not a bad start at all. This Tuesday morning.
I think, it's a very good start, especially in the mid-cap index. Just look at that, 230 points higher now. Happiest Mind is the one that's taking a big beating because there's 8% equity that has changed hands over there, and of course all the news flow surrounding it. So Happiest Mind is the one that's down 8%. But on the upside, Amara Raja Batteries is really the stock in focus. 11.5% higher on Amara Raja Batteries now. Big volumes are picking up over there on the back of the technology collaboration that they've signed for lithium-ion cell batteries. So a lot of brokerages believe that this is a step in the right direction. This is a re-rating moment for Amara Raja Batteries. Both Amara and Exide actually have seen huge re-rating in the past many weeks and days. Zomato, let's look at that one. Data shows that Zomato's market share has expanded across both its food delivery and quick commerce segment. So the stock is up about 2.5%. But let's not forget that the stock has rallied about 60% in the last 6 months alone. That's the kind of move that we've already seen. How much of it is in the price, no one knows. But for now, Goldman Sachs also saying that the scale of Zomato's growth in quick commerce is now 50% larger than its competitors. So big moves coming in over there. Apart from that, you have many other stocks that are looking, not too bad actually this morning. A couple of the sugar names are doing well. But on the flip side, apart from Happiest Mind, there's Bandhan Bank that's down about 3% IRDA is a tad bit under pressure. Railtel is down about 0.8%. So these are the list of movers in the broader market. From the frontliners, the one that's really holding fort this morning is HDFC Bank and SBI. So both these stocks are up 0.5%, making sure that the Nifty stays above the 23,580 mark.
Well, there's one more stock, Crystal Integrated Services, and here Nuvama has initiated coverage on the stock, and the stock is surging. It's a small company, 1,200 crore in market capitalization. It gets more than 50% of its revenues from managing facilities for companies, lots of government business. They also provide staffing, catering, and that stock is up close to about 6–7%. The target price set by Nuvama on Crystal Integrated Services, it's Crystal with a K, is 1,369, which means a good 75% upside from current levels. They believe the valuation is attractive. It's just trading at about 11 to 11.5 times forward multiple. So that's a stock, which is seeing a lot of action today. Borosil, where the company has launched a QIP, 150 crores is what they're looking to raise. The stock has surged about 5–5.5%. And TBO Tech continues to see buying from yesterday. It was one of the big winners, a 7% up move, 8% I think on TBO Tech yesterday. It's followed it up with another 4% gain. And today, Axis has initiated coverage with an ad rating. Target price is 1,920, valuing it at 50 times FY26 PE, they say. But they do acknowledge that an 80% up move since the listing leaves modest upsides to their target price of 1,920. All cargo also, which, where there is news, the stock is open with a gain of about 2.5%. Bandhan Bank is under pressure. The news appeared to be neutral, the appointment of, a retired RBI person on the board, but the stock is under pressure, and that's down close to about 3%. Some weakness coming through in MRPL, IREDA, JK Paper. These were some of the stars in yesterday's trade. Many railway stocks which rallied, like Ircon, are seeing some amount of profit booking. And on the way up, it's, I think Amara Raja, which is now up close to about 10%. And PNB Gills is also rallying on pretty good volumes.
I mean, it's a market full of stocks, right, which is how it should be. I mean, at a broad index level, you'd kind of say, well, there aren't that many cues, and that you'd be absolutely right. But then it would be a mistake not to look beyond the surface where there is so much action and activity. Actually, at an index level as well, I don't think there is anything to really complain with the market cruising along quite nicely. So that's the overall picture which is coming through at this point in time. So the big block deal, which is Happiest Minds, taking place, stocks down, of course, reflecting the discount which is on offer. And otherwise, I mean, it's a very strong day. Amar Raja, as we were talking about earlier, is perhaps the stock of the morning at least, with a big 11-12% gain. So we'll talk more about this, and hopefully we'll have the management join us over the next couple of days to talk about this in terms of what it means. I was reading a note from Kotak in the morning, Kotak Institutional Equities, who were essentially saying that, because their view is that the valuation as of yesterday's close already kind of prices this in. I mean, technology transfer, etc., is good, but it's always the question of what's in the price and how much you're willing to pay for it. But right now, this morning, market's very happy with what has been done on Amar Raja. So that's what we have. We have Shreyas Devalkar. He's head of equity at Axis Mutual Fund. He's joining us now to talk to us about markets, talk to us about how they are positioned. Shreyas, good morning. Good to have you with us here. Thank you very much for your time. Prashant this side. Shreyas, vibrant market, isn't it? I mean, if you're willing to maybe sort of go down the curve a little bit and widen the horizon, as many on the sell side are doing with newer initiations, etc., every day, a few at least. How are you looking at how are you and the team at Axis looking at markets from here, Shreyas? Many have complained that, well, it's kind of hard to find ideas. But are you of that view, or you think you got to be willing to maybe look a little lower down the market cap curves now? Go on.
Yeah. Good morning. Actually, as far as markets are concerned, always at this stage of the market, it always gives us a feeling that all stones are turned and nothing is left. And that's where the existing, the stones which are turned already, obviously are at the elevated valuation. So at this juncture, there are two ways that you are suggesting. One is you try to find out more and more. That process, irrespective of market, is always on. It's not that current level. But then there are certain opportunities which are there around data centers, around EMS, and more are coming up. More companies are tying up around those spaces. So those opportunities in that segment especially is where probably currently market is trying to find out more ideas. But when it comes to the segments like power, defense and all, their market has definitely evaluated and discovered most of the stuff. So that's where at this juncture, the point comes back to what is and where is that sustainable growth. Just try to sit back and try to see that beyond the themes and where there is really growth and where there is a risk reward favorable. And then when you observe that, then what you will observe is, especially when it comes to the movements of large, mid, small cap segments in last 4 years almost, it is observed that generally in the large cap segment, some of the pockets which has underperformed definitely, and that's where we are also trying to find out ideas now where there is where market has focused overly on near-term growth and valued them at 50, 60, 70p. So instead of that, try to focus on where the growth may be relatively less at 12 to 18% kind of growth instead of 25 to 30, 15 to 30, 25% of growth. But then the valuations are really in favor, and especially adjusting for the free cash flow generation ability of such businesses. So this is how we are looking at this juncture.
Okay, by the way, just wanted to mention a couple of stocks along with Amara Raja Batteries, which is now, by the way, up 15% on the back of that technological arrangement. Exide is also at a fresh high this morning. So Exide is up 3.5%. It's a fresh 52-week high. Both these stocks, because of the huge potential in lithium-ion battery manufacturing, Amara and Exide are really surging this morning. Indian Hotels is the other one, fresh high on that name. The evergreen theme of travel continues, travel and tourism. So Indian Hotels is at a fresh 52-week high, almost at 660 rupees now over there. And a couple of other names that stand out: ITD Cementation, Suprajit. Trent is at a fresh high, 54.27 now on Trent. Big moves coming in on that name. Shreyas, hi, good morning, and thank you for joining us on the show. I wanted your thoughts on quick commerce, right? Just because Zomato is in the news so much, I mean, data shows that Zomato's scale is now 30% larger than Swiggy, for example. And, we've all seen the way Blinkit is performing. If someone has missed out on this rally so far, do you think this is a structural story, a structural upcycle in some of these consumption names?
So good that you highlighted and tried to focus on the consumption names back, because generally market has been more focusing on the investment part of economy, especially and in last 2 to 3 years, and rightly so. Some of them have shown that kind of movement. But when it comes to consumption, definitely there are structural changes and the underlying trend which is happening. And one being especially in the retail industry. So retail industry, what we have observed is there is, so if you just try to break your consumption space into the FMCG versus retail, then generally we always positioned ourselves more on the retail side because there is a room for growth in that. And in that retail industry, now these are the next steps. So first is home delivery started with, then quick commerce. And considering the demographics, considering the diverse nature of India, it's both combination of city, then there are suburbs, and then there is a demand from the new age, the new generation, and that's where the consumption trends and the patterns and the usage patterns are changing. So first is obviously the trend is on, but then as an investor, we need to definitely focus on the profitability, our path to profitability. And we have seen that when it comes to home delivery, the profitability part was not lucrative earlier. But then end of the day, first even QSRs never used to show very high profit, and then the QSR started showing profit, and that was the first form of the home delivery. Then the other companies which are the which started with the home delivery as such quick commerce, they also started showing you path to profitability. So quick commerce also with the scale and learning, etc. So we hope that even that part also shows path to profitability.
Shreyas, morning. You also manage the mid-cap fund, the mid-cap fund, and you've been active on that front. Where the argument on valuation versus liquidity, because liquidity appears to be driving up the valuations to astronomical levels in some cases. So how are you managing? Because if you miss out on it, then the fund underperforms. So where is it that you're seeing value right now? Take us through the thoughts of picking up mid-cap stocks now.
So mid-cap, if you observe in last 1 year or so, actually the observation is for 2 to 3 years, but especially last 1 year or so, definitely the valuations are elevated. Generally, among large, mid, and small, one observation is mid-cap segment had a higher proportion of PSU in the underlying benchmark. So it is upwards of 15% in the underlying benchmark, the PSU contribution. And that's where the mid-cap as a segment actually outperformed or did in line with small cap in certain time period. And it has outperformed more because of that. Because PSU rally has seen a very sharp rally in last 1.5, 2 years. So that is where the mid-cap segment is. Now, if you just try to dissect that segment, then the capital goods part, that part definitely, and anything to do with industrial, so it's industrial capital goods, that part definitely it is at elevated valuations, no doubt on that. There are pockets, especially in the consumer durable part, and in overall consumption space, there probably the stocks have not moved a lot in last over last 5 years. So that's where we are just looking at more of where there is a lack of re-rating over a 5-year period, because in last 2 to 3 years especially, everything has gone up. So that re-rating potential where there can be with the delivery of earnings, that's what we are trying to look at. And that space one need to find, especially in the consumption basket, mid-cap. Generally, you'll observe that FMCG has higher representation in the large cap, while mid-cap has more representation of consumer durable and discretionary.
No, got that. Shreyas, stay with us. I'm going to come back to you for more, but let's also bring in Niket Shah, who's with us. He's Chief Investment Officer at Motilal Oswal Mutual Fund. Niket, good morning. Good to have you with us here. It's been a while since we've had a chat. Just weigh in on how you are approaching markets from here on. Let's just actually dive straight into one particular sector, right? Motilal as a fund house has been pretty bullish on this entire telecom theme. Vodafone Idea, for example, in the FPO, etc. He's done well since then. Now, of course, it's the test of actual tariff increases. Markets are waiting for it. What is your sense? What are the best plays here in the space, and what's the story? How is it likely to play out?
So thanks for having me here. I think clearly, as you articulated on telecom, we looked at this theme in the initial part of the year, somewhere around Jan or Feb. And I think two things to really play out. One is obviously the tariff hike, as you rightly articulated. But I think the second part is the balance sheet improvement, right? If you look at the last 10 years for telecom, there was impact on balance sheet because of the high capex cycle in 2014-15. And then a tariff war which happened from 2018 to 2021, which deteriorated balance sheets for most of the companies on the listed side. What we are now seeing with tariff hike increase is the P&L will improve first, and then the balance sheet will start improving later on, which should actually lead to improvement in return ratios and hence valuation over a period of time. So we are extremely optimistic on this entire theme. We are in fact 7 to 8% overweight on telecom since beginning of this year. And we believe that some of these, themes like, the tariff hike increase or, the reduction in the AGR liability should actually play out over the next, 3 to 6 months.
Without getting outside of what is already published and what is available information, Niket, are these operators the best way to play the theme, or could it be, say, an Indus Tower? Do you have exposure there, just to kind of complete that loop?
So we actually have exposure across the board. We have exposure to some of the listed telco names, some of the equipment guys as well, and indirectly, from the leader in the business as well. So we believe the leader, which is obviously the channel that you own, is not listed, but I think you can obviously pay through the listed company out there as well, which is a holdco company as such for now. So we have actually played across the board. Every stock within the telecom sector is there in our portfolio today. We believe the whole ecosystem will do extremely well over the period of next 2 to 3 years. And we actually think that Indian tariff is actually at a substantially lower price than if you compare with anywhere in the global markets. So I think one should not assume that this is the last tariff hike and things are done. I think you should see a tariff hike even next year. So this eventually becomes a 2-year story for us.
Okay, that's very interesting. 2-year story in telecom and overall positive triggers for the sector. Niket, hi, good morning. Good speaking to you. I wanted your thoughts also on quick commerce. We were just having the discussion with Shreyas as well. And you folks at Motilal have been positive on names like Zomato for a bit. But I want to understand this from you. This growth rate that you're seeing, right, 30% GOV, 25% GOV, is it something that is sustainable? Because there's now increasing competition in this space as well. So for listed players, can this pace of growth continue?
So I think on food delivery, you should see about 25 to 30% growth sustaining at least for the next 2 years. And I think there is no major competition intensity beyond the two players that we're talking about. When you move to quick commerce, I think the growth rate will accelerate this year. I think the consensus expectation is about 60 to 70%. Our sense is that most of the companies in the space should actually grow at more than 120 to 130% this year. So I think the quick commerce is here to stay. And I think the growth rate will accelerate. Obviously, most of them have actually announced that they're doubling their dark store capacities this year. So it's driven by expansion of capacities. And I think obviously you are seeing traction within the existing stores as well. Last but not the least, I think the way this eventually is going to play out is, some of the larger e-commerce guys in India will actually get impacted over a period of time. If you look at our shopping habits today, something like a mobile phone, which was typically used to go to a larger e-commerce guy, is now going to be available on a quick commerce as well. So effectively, there will be a significant amount of value migration from a larger e-commerce players On the unlisted side, obviously, some of them are MNCs to some of these quick commerce guys. So this will become a one-stop solution for a consumer, whether you're spending any money at home or if you decide to move outside your home and start spending there. I think entire value chain will clearly get captured over the next 2 to 3 years.
Morning, Niket. I wanted to get both of your views on the kind of supply that we're seeing. On one hand, promoters' funds are encashing, and it's making some people uncomfortable, just the pace at which we've seen block deals. But on the other hand, you can also argue that it's not just retail, who's buying the supply. It's also smart money, mutual fund managers like all of you all who are buying the kind of supply. So what have you made of this?
Well,
okay, if you want to go first, and
Yeah. So actually, to be very honest, we have been avoiding most of the blocks that has actually happened in the recent times. And we have, when we look at all of them on a case-to-case basis, it's very tough to make an investment rationale out there. We have been slightly more active on the IPO side of the market, but on the block side, we have been extremely inactive. And, in a cricket match, there are times where you hit a ball out of the ground for a 6 if there's a full toss, but there are times where there's a yorker. You really need to be very, very careful out there.
Shreyas, you want to weigh in on this debate of the kind of supply that we're seeing and the pace of it?
Yeah, definitely. So actually, when it comes to supply as such, definitely it is good, in my opinion, to the extent that in some of the segments, especially in mid and small cap, there is the free floats actually will increase in this. Now, the question is whether one should buy into it is really case specific, because on the one hand, higher supply and better free float is good for market and good for price discovery as such. While on the other hand, whether one should get into it is on a case-specific basis. We generally try to look at whether the company is getting the money or not. So certain criteria we have, and accordingly we act. So it's not a blanket answer for that.
Shreyas, just, when we started this conversation, you mentioned data center as an opportunity. Can you be sort of specific if you own and it's public? What's the best way to play this theme?
The data center as an opportunity is definitely there, and there are multiple segments which are coming into this space. So it can be right from, so now if you look at the value chain in data center, so one is, it is an asset owner or someone who is trying to build a data center. So generally it can be a real estate company, and most of the time it is a real estate owner because that is where, from the owner's point of view, some of the value lies. And that's where there are certain companies which has gone into this space. Then when it comes to what is there in the data center, then mostly when it comes to its racks and its electronics, probably there will be limited companies one can look at into this space. But definitely then it goes to the power supply, uninterrupted power supply. It actually starts with the power supply right from the primary power supply to the backup power supply. And now here there is opportunity one can see. So you have to look at opportunity across the asset owners and the suppliers. And always we have seen that over longer period of time, in the markets actually, so whether it is a power cycle or it is any other capex cycle or any other asset ownership cycle, generally someone who is supplier, they have made, market has made more money than the asset owners.
Got it. Niket, I wanted your thoughts on some of these battery makers, right? I mean, the kind of evolution that's happening in the EV space with this whole lithium-ion battery technology. Companies like Exide are, signing contracts with huge global players like Hyundai, Kia, etc. For an average investor, is there more scope in names like this?
Well, I think there is, because I think from a supply chain standpoint, clearly we are looking at some of these large OEMs looking out for an Indian vendor. So I think the one who really goes live first really has a big benefit out there in terms of sourcing. And because most of the guys, including the leader in the business, is likely to come out with their EV vehicle sometime next year. But I think the real important point that one has to keep in mind is that one of the company which has more than 50% market share on the PV side typically wants to do this in-house over a period of time. So effectively, the size of opportunity for a large amount of battery guys is going to be limited to the balance 50%. And that balance 50% is where the opportunity lies. So the one who really goes live first really makes most of it, over a period of time.
Got it. Niket, two questions. One, what are some of the newer emerging themes that you're betting on? We spoke about a few. That is one. And second, are you adding newer, completely unknown names? I mean, unknown at Motilal. Are you adding newer names every month? I mean, we are seeing. I was talking about this a lot of on the sell side. New initiations, right? It's not as if some of these stocks have not done very well. It's just that, I mean, formally now institutional coverage is beginning. It gives a stamp of sort of, whatever, respectability, if you want to call it. But the stocks were doing well in any case, even without coverage. But it allows, I think, institutions to come in. So I just wanted to get your sense there as well. Are you adding newer names every month? So, yeah, go on.
Well, not every month, but we definitely don't want the portfolio to remain static. If you have a static portfolio, then obviously it underperforms over a period of time. So you have to play the cycles very well. But I think the newer theme, that the point that you articulated, I think one big theme that we believe is going to play out for the next 5 years is this whole Apple ecosystem in India. So if you look at Apple's export from India, has been $1 billion in April month, standalone month. Single month, India has exported $1 billion worth of Apple products. So on an annualized basis would be about $12 billion. We believe this $12 billion should move closer to $50 to $60 billion in the next 3 to 4 year period. Now, the whole ecosystem of this is something that we have really focused on. We have made investments in that direction. We believe it's going to be a 5 to 7x kind of a size of opportunity from current levels. And these are very initial days as far as this whole ecosystem is concerned. So till now, what we've generally seen is this whole mobile assembly in India. Now we believe the whole component ecosystem is going to go live in the next, hopefully next 1 year. And you will see a lot of government action in that direction, which government has been saying about PLI in mobile phone as well. So you should see that extending to component ecosystem. But we are specifically focusing right now to the whole Apple ecosystem, where we believe the size of opportunity is very, very large. And that could be the theme for the next 5 years. The second important theme is the whole export theme.
Sorry, just what kind of names there, Niket?
Well, I'm not allowed to mention names, but if you look at some of our portfolios, you will see, some of our portfolios being much more readier in that direction on the small cap side, as well as on the mid cap side.
Okay, export opportunity?
Second, I think, is like export opportunity. So I think we clearly believe that, in the next 12 to 18 months, I think IT will make a big comeback. It actually has been an underperforming sector on the large cap side, not so much on the mid cap side, but we believe, with telecom that we did last year, we believe in the current year, we should see a comeback of IT, which should go all the way to the next year, December month. We believe AI is now a reality, and you should see increased traction from AI coming up. So I think if you take a higher growth rate in IT, then the valuations are much more reasonable. So at a time where within the mid cap and small cap space, valuation is a concern, but there are sectors and spaces where valuation is still much more reasonable. So we have taken about a 10% overweight position right now on the IT side as such.
Okay, it was a pleasure speaking to you, to both of you actually. Thank you so much for joining us on the show, both Shreyas and Niket. Very helpful over there. For the market, just wanted to take one quick look before we proceed. Not bad actually. The Nifty is holding with gains of about 50 odd points. The mid-cap index is where all the action is at. So the party is right there. 230 points higher on the mid-cap index. But let's now focus on Shriram Finance. The company is selling stake in their housing finance business to Warburg Pincus. This stake sale will happen for 4,630 crores. Y.S. Chakravarti, who is the MD and CEO of Shriram City Union Finance, is joining us now. Mr. Chakravarti, good morning and thanks a lot for joining in. How much will your capital adequacy ratio strengthen by, sir, with this stake sale of Shriram Housing to Warburg Pincus?
See, it's not a significant addition, but yeah, it will be, I think, up by about between 1 to 1.5%.
Okay, 1 to 1.5% is how much the capital adequacy ratio will go up by, is it?
Yeah.
Okay. Can you tell us what is the outlook as far as the business is concerned? I mean, are you seeing any signs of pain at all in the rural markets? Because, we have seen a lot of MFIs have talked about how asset quality is worsening. We've seen the NPAs go up as well. Wanted your thoughts on how things could shape up over the next 12 to 18 months?
No, as of now, we don't see any strain, very honestly, because see, our basic rural business is our two-wheeler business, our gold loan business, and small business loans. I'm not seeing any stress in these lines as of now. And even on the transportation sector, I think things are going well. Last 2 months were good. April, there was some slowdown. Typically, beginning of the year, kind of a slight slowdown, but May has been good. And June so far is performing well.
But in the last conversation, you indicated that election is slowing things down a bit in terms of demand. But you're saying only the month of April was subdued. May and June has been on track. Can you give some numbers? What were the disbursements like in April, May, and even most of June?
So I would say this quarter, year on year, the quarter would be better. I'll not be able to give you the specific numbers as of now, but as of today, we are ahead of last year's numbers. So both of collections as well as disbursements, we were slightly ahead of last year's first quarter. So the elections, we were actually a little apprehensive that it will slow down, but compared to last year, it was actually slightly better.
Yeah. Your AUM growth guidance is 15%, Mr. Chakravarti. Morning, Prashant here.
Yeah, morning.
You've in the past highlighted that there could be some upside risk. You'll see, you'll revise it as you go along, if needed, that is. Are we at that stage?
I wouldn't call it as an upside risk. I would say there is an upside potential.
A potential, sorry, yes.
So,
yeah.
We will do that probably post second quarter.
Post second quarter, but it could be higher.
Possible. Possible.
Okay. You want to sort of quantify? I mean, you have visibility, right? I mean, how things are going. I mean, I'm not asking for a number. Yeah.
Yeah, I know. We are slightly, as I told you, we are slightly ahead of the last quarter as of today. So if you are able to hold this here, the third and fourth quarter should give us a good growth number.
Yeah, no, got it. Now, just one point, this is not sort of really about Shriram Finance in that sense, but about the industry. We've seen, over the weekend, for example, you had this farm loan waiver which was announced in Telangana, right? We are hearing murmurs in other states as well that something could happen. There are state elections, etc., also around the corner. What does it do to sort of overall credit quality in that sense, Mr. Chakravarti? And is there any sort of at the margin kind of impact for a business like yours?
No, because again, the farm loan waiver was also limited to basically on the number of acres that a farmer holds and the loan amount. Yeah. So it's basically, it will definitely benefit the marginal farmers. I don't see an impact on our margins or business per se. It should actually put a little more money into the hands of the marginal farmers. So which should be okay good for the rural economy.
Okay. So, earlier when we started, you mentioned that your capital adequacy ratio would strengthen a tad bit, but I didn't get the exact number. The CRAR, what will it strengthen to, if you could tell me, over the next 1 year?
Probably we will see. I think right now we are around 20%. So it will go to about 21 and a half.
21 and a half. Okay, got it. I also wanted to know what's happening with the commercial vehicle side of the business, because the entire sector is, seeing a bit of a decline. The OEMs are not very confident of even single-digit growth, perhaps in FY25. I want to understand, how do you see CV financing growing in FY25?
So let me put this way. So specifically on the CV side, the construction side, it's still there is a demand there on the construction side, like tippers and construction equipment. The demand is still there, and in certain states we expect the demand to actually go up. For example, a state like Andhra Pradesh, they are actually focusing a lot on the infra. Probably states like that, we will see an uptick in demand, and consequently the used vehicles also market also we should grow. So I would say it's a mixed bag. The MHCVs have slowed down. LCV there is a little slowdown on the LCV side also, but on the used market there is a robust demand on the used vehicle market, basically because of the cost of the new vehicles have gone up, so there is a good demand for used vehicles. Again, supply side, yes, even in the used vehicle segment, there is a slight constraint on the supply side because the replacement cycles have gotten longer, where people were replacing between 3 to 5 years. Today, it's going to 5 to 6 years now. The replacement cycle has slightly gone up, so the supply is also a little down in the used vehicle market.
No, I mean, would you give it a push? Would you give the CV segment a bit of a push by sort of changing LTV or product sort of loan tenures, etc.? Or no, not really.
LTV is no, definitely no. We want to have a great margin there, but
Okay.
see, it's not a question of LTV. Again, supply itself is limited supply, so you need to actually base. I would put it this way. So since supply is low, you need to actually hold on to your customers and make sure that in the replacement market, the customer you don't lose your customer.
Okay. No, I meant help. I meant to push in that segment. So CVs slightly slower, right? As opposed to some of the other segments. What about MSMEs and gold? I mean, those two have been sort of big drivers for you. How is that shaping up?
Both are doing well. In fact, these are the two focus products for us since our merger, and we have MSME loans, because both gold and MSME, because of the addition of the commercial vehicle branches to the network, we were able to increase the point of presence there. So we will continue to push both of them.
Sir, you've been in conversation with rating agencies also, pushing for perhaps an upgrade. Now with the divestment done, your capital ratios picking up by more than 100 basis points. Where have the conversations been with rating agencies? Are we likely to see an upgrade, or what's holding them back?
It's an ongoing dialogue, and I mean, what's holding them back is something that they have to answer, because we've been pushing and we feel that we are the right candidate. We have proved that the merger has worked and the merger is producing results. I mean, we are doing all we can, so now it's in the hands of the rating agencies only.
I know you said that you've not seen stress in the rural economy as of now, but some of the peers are talking about it, particularly on the MFI side. There was one small finance bank which went ahead and increased the credit cost, the guidance also, the amount that the credit cost would be. Your guidance is about 2%. Are you still maintaining it, or is there a risk to that?
No, we are still maintaining it. We are pretty confident that we will be able to hold it there.
Okay, and on margins? On NIMs, what's the outlook?
NIMs also, as per guidance, we'll be holding it. I mean, we don't see as of today, we don't see any decline in our lending rates, and the margins are holding up. See, I'll put it this way again. Probably, since we have a basket of products, there could be a slight decline in the margins in, say, a commercial vehicle, but that will be made up in a two-wheeler, a gold, or an MSME. So it's basically a mix of, since we have a mix of products, so we are able to, manage that.
All right, got that. Thank you very much for joining us, sir. Appreciate you sort of taking out the time, being with us here on CNBC-TV18, and good luck to you. So very, very steady growth, 15% AUM growth is the guidance for the medium term. But as Mr. Chakravarti said, it could be an upside there, but we'd only know after the second quarter numbers sort of come through. They'll be able to sort of quantify that if there is an upside. We'll take a quick commercial break here. We'll come back. We'll connect with Pankaj Kumar, Vice President Research at Kotak Securities. We put the spotlight on real estate and what's happening there. Stay tuned.
Well, let's get the spotlight on the realty sector now. According to Kotak Securities, residential real estate sector has scaled to new highs in FY24, touching a lifetime high of 1.1 billion square feet. To discuss more on this sector, Pankaj Kumar, Vice President Research at Kotak Securities, joins in. Pankaj, thanks a lot for joining in. You know, you don't need all of this data to tell you the kind of boom in the real estate space, right? Just one look outside in Mumbai and you'll realize, I mean, with the kind of skyscrapers that are hitting the streets. But tell me a little bit more about the numbers. What are the numbers now in the residential real estate space compared to what it was a year ago? And how sustainable do you think these numbers are?
Good morning, Sonia. So as you rightly pointed out, there's a boom in the real estate sector that we have seen. And FY24 numbers, if you look at overall for the sector, has grown at 20% on a YOY basis. And it is roughly 1.1 billion square feet. Even for the larger players, if you see the listed companies, they have grown well. Most of the large companies has grown at even more than 20%. And for the guidance, if you see FY25 guidance as such, most of these companies are guiding for double-digit growth in pre-sales. So demand continues to remain strong. There are multiple factors. If you look at the industry, it's consolidating, and that theme is continuing. And if you look at the inventory, so inventory in the system is still 1.3x of trailing 12-month pre-sales. So that's also on the lower side. And the launch pipeline for most of these companies continues to remain strong. So we continue to see healthy volume growth as well as the value growth in the coming year.
What's been the price increase that we've seen so far in Q1, April to June? And if you could just break it up, market, at least geographically.
So if you look at the volume price increase, that's been healthy. In fact, for FY24, it's 11% price increase that we have seen. But price increase is largely driven by your inflation as well as some minor increase in the prices that we see. So it's not that substantially high, but there's a demand that's continuing, and moderate price increase is supporting that.
Okay. So this lifetime high, all India residential sales, lifetime high 1.1 billion square feet. Going forward, can you just break it up for us into geographies? Where do you see the maximum traction coming from now in terms of residential sales over the next, say, 12 to 18 months?
So if you look at the listed players that who are guiding for a very strong growth, say 20%, most of these companies are located in the large metros particularly. And we have seen the south-based, Bangalore-based companies or even Mumbai-based companies are guiding for a healthy growth of 20% plus kind of numbers in FY25. NCR, to some extent, we have seen 15% kind of growth, what the DLF has guided. So you can get a sense like how the year looks like.
How are the valuations of the companies that you track? How does it compare with, say, a 3-year average or a 5-year average? And where is it that you're most comfortable in terms of valuation?
So as you rightly pointed, the valuations for these, most of the listed companies currently is in a range of 7 to 12 times on a forward EV to EBITDA on a pre-sales number on FY26 estimates. So 3 years ago, these numbers were on the lower side, say 4 to 6x. So that has come up in the higher band now. So that shows that there is optimism, of course, and the numbers are also supporting, because the growth rates that we were estimating 3 years back were not that what we are estimating now. Even the companies are launching to that extent and selling also. So the valuation is itself reflects the growth that we are estimating.
Is there a risk of oversupply in any of the micro markets? Because there's been so much construction activity happening. We see that in Mumbai, particularly in this whole lower Parel area. So, is there a risk of oversupply, and could that dampen price increases? You spoke about 11% price hike last year.
So, in terms of overall supply, if you see, of course, there is a supply, but there's a demand which is matching that. Because if you look at the overall inventory in the system, so even for the Mumbai market, it's not that high that we have seen 3-4 years back or even the previous cycle. So it's still in a less than 2 years kind of that's sales numbers that inventory numbers that we are looking having as of now. So we are still seeing a good demand. Inventory is not high in the system, and there is a stable price increase as well. So that is supporting that demand.
Okay, we'll leave it at that. Thank you so much for joining us and taking us through the realty sector and what you see as the way forward. The market is quiet. A little bit of a positive bias is what we're seeing right now. Mitesh Thakkar is joining in. Mitesh, hi. Welcome back to the show. 23,600 thereabouts is where the market is consolidating at. Do you think this could be the order of the day? What are the stocks that you're looking at right now for the rest of the day?
So Sonia, 23,600 is the actually breakout point for the short-term traders. Last 2-3 days, we've seen hourly pivots being formed over there. And today we got an intraday high of 23,620, but failed to sustain above that. So once we get an hourly close above this today's high, I think we could see some momentum kick in. Till then, I think, hold your horses. On the stock side, though, I have a buy on Navin Fluorine with a stop below 36.45 for a target of around 3,800. Then maybe we can look at even higher levels over there. And a sell on Aurobindo Pharma with a stop just about 12.31 and a target of 11.60 on the long side.
Mitesh, in the PSU space, you already have recommendations live?
In the PSU space, Prashant, we are now looking at situations wherein most of these stocks like BHEL, Coal India, BEL, etc., going through more of a pullback and a sideways consolidation. So from a trading point of view, next 3-4 days, I would avoid PSUs. I don't think there's any significant directional movement happening.
Okay, yeah. Yesterday we saw some pullbacks, right? SAIL, Concor, the fertilizer names, of course, etc. as well. Credit access, any thoughts here, Mitesh?
I'm not tracking that stock, sorry.
Okay, all right. Stock sold off about 4-5% yesterday. And it's, of course, the top tier sort of microfinance player out there. So 1,400 there on credit access. Quiet. Actually, the index is pretty quiet, but at a broader sort of broader market level, there is enough activity, which I think is very much underway right now. Mitesh, we'll talk again a little later. We'll take a quick commercial break here. Manisha is going to be here. We put the focus on commodities. Stay tuned.
Okay, well, the market is slowing down. It's not doing too much at all, really, to be honest. It's just that a couple of these stocks like Zomato are in the news. Then you have, of course, these battery manufacturers that are big. Some of the CV makers, Ashok Leyland is at a fresh 52-week high, so that's looking good. And private sector banks coming back in action. So ICICI Bank, by the way, is at a fresh 52-week high as we speak. But let's go across to Manisha Gupta to get a quick update on what's happening in the world of commodities. Manisha, over to you.
Thank you for that, Sonia. Well, the month of June hasn't gone down well for metals as a sector. April and May were amazing, but June clearly seems to have wiped off much of the gains that the month of May put out for you. So the strength in US dollar is one of the reasons for that to happen. And then every data that you saw come out of China has been on the weaker side, especially the property numbers have been all on weaker side there. If you look at the numbers there, the new home prices in 70 Chinese cities declined by 4%. And this is the lowest number that you've seen on board come in since 2015. Also, when you look at the investment numbers and the home prices, home sales as well, all of that data has been on the weaker side. There has been a 34% decline in annual sales from 100 construction companies there. So every number, as I said, that you look has been on the weaker side. The construction activity and the investment numbers in sense of property have continued to slip as well. You know, earlier it was about heat waves and not just India, but various other Asian countries were looking at that as well. And then now there are heavy rains happening in various areas. So the construction activity clearly is looking at a stalling effect from various places. And that has been putting pressure onto the markets. So when you look at the steel prices, we're looking at a 2-month lows onto this one, trading below 3,400 yuan per ton. Not just steel, iron ore prices are trading at a 2.5-month lows. You have copper prices, which have continued to decline as well. That one is trading at a 2-month lows at 4.4. All-time high has been 5.2. And on LME, the copper prices, after hitting an all-time high of 11,100 in the month of May, are trading between $9,500 to $9,700 a ton. So base metals, ferrous metals, non-ferrous metals, all of that have seen some weakness. The only area that we've seen some support come in has been the zinc and lead prices, but that is also because the surplus in these commodities seems to be going off. But as and when you will see markets looking at inventories increasing, you could be looking at some pressure increasing here as well. I want to show you on what the metals have done in the matter of the month of June. And as you can see, almost everything has seen a decline. Starting right from copper, which has fallen by 8%, you have a 5% decline in steel, 9 to 8% cut coming in for iron ore and lead as well. And it's a similar story when you look at other metals like zinc and aluminum. Nickel clearly has been an underperformer with nearly 15% of a decline coming in. But all of these metals and other asset classes will watch out for the US inflation data that comes in on Friday.
Okay, thanks a lot for that. Well, we're watching out for a stock like Craftsman Auto as well. The stock is up in trade today. It signed an MOU with Sunbeam Lightweighting Solutions and Kedara Capital Fund. They are looking to acquire either the whole or part of the business of Sunbeam in one or more tranches. So there is an acquisition that they are looking at the moment. The transaction excludes certain assets in Gurugram, but there are no further details given on the timeline of or the consideration that they will pay for this particular acquisition. Now remember, Craftsman Automation is a manufacturer of automobile parts. They produce gears, heavy parts, sheet metal equipment, special purpose machines, etc. Since its listing in March of 2021, the shares of Craftsman Auto have risen 250% from their IPO price. The IPO price was $14.90 per share. Today, the stock is at $5,200. So it's been a huge up move. And on the back of this potential acquisition that the company might do, the stock is up almost about 8.5%. So big moves coming in over there. But Happiest Minds is what you're tracking?
Yes, because there's a large block deal of 1.27 crore shares. That's 8.3% equity, which is totally valued at 1,076 crore rupees. This is slightly more than what, in the morning, what we had picked up is it's going to be a 6% block deal. But it turns out it's been an 8.3% block deal. The average price is at about 847. The stock is currently hovering there. So it's an 8% fall compared to where it closed yesterday. Now, sources suggest that the promoter, Ashok Soota, has sold his stake. His stake was about 50.1% as of March, and with this, it will decline by close to about 8%. In the past also, Mr. Ashok Soota has sold stake in the company. In September of 2023, he had sold a 1.1% stake to raise funds for his other ventures. But at that time, the communication shared by him to the company and to us is that his stake will not drop below 40% in a way to quell, any kind of, worries that the promoter stake sale will keep coming. But he had indicated that at least till 40% he may go. And we've seen a very large block deal today, which has put pressure on Happiest Minds. So the stock is, being weighed down under that. But broadly today, IT is also on the back foot. HCL Tech is now the top Nifty loser. It's a cut of nearly about 1%. LTI Mindtree is weak in trade. TCS is a fall of nearly about 0.5%. So IT is, on the back foot, even as banks are picking up some of that slack, with the Nifty Bank now up close to about 300 odd points.
Okay, well, let's do one thing. Let's take a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Anubhuti Sahai of Standard Chartered Bank and Aditi Nayyar, the chief economist at ICRA, to discuss the India's current account surplus. Stay tuned.
Welcome to It's the Economy. It's a magnificent set of numbers that we're going to analyze today. For the first time in 11 quarters, India has posted a current account surplus. Now, we must absorb the significance of what this means. About 33 years ago, India had only enough dollars to pay for 3 weeks of oil imports. That's when the IMF threatened to make India a defaulter and the great liberalization was ushered in. Even 11 years ago, in 2013, Indian rupee was classified as one of the fragile five. Why? Because the year before, we had a current account deficit of about 5.2% of GDP. So the rupee has always been under pressure because we import much more than we export. But this year, or rather in the quarter Jan-March 2024, we have reported a current account surplus. Now, what has generated this huge difference is our improvement in our services exports. Software services, only software services have risen by about 9% to $142 billion. There is a new category called business process exports. That's largely this, the non-software part of the GCCs, the global captive centers. That has generated inflow of $29 billion. That's a 40% jump over the year ago number. And then there are Indians living abroad and sending money in. The Indian diaspora has expanded, so have the remittances. And we have a huge $106 billion or $105 billion coming on account of this. That explains the current account surplus. But current account surplus also means that India is sending savings abroad. A deficit means investments flow in. A surplus means India is exporting its domestic savings. So is a huge surplus very good? How do we balance the two? What can it mean on the rupee? Are all questions that are thrown up. Too much of a good thing is also bad. For all these questions, I'm joined by two economists, Anubhuti Sahai, the head of South Asia Economic Research at Standard Chartered Bank, and Aditi Nair, the chief economist at ICRA Ratings. Ladies, thank you very much. It's a great set of data to discuss, and I'm glad that we three women are discussing it. First to you, Aditi. The first question really is, does this start a period of very stable current account for India? There were times when we used to have a 3% deficit, and it used to keep the rupee jittery. Is that period completely over?
Thanks, Lata. Well, certainly this is a really good set of numbers, better than what we were expecting. We had penciled in a small surplus, and this has exceeded our expectations. One thing I would like to say is that it's possibly going to be transient. We are expecting the current account to revert back into very modest deficits from Q1 onward. So nothing to worry about. In fact, the size of the deficits is likely to be quite limited, 1 to 1.2% of GDP for FY25 as a whole. So overall, we do think that the current account situation is going to be a big part of the macro stability that we're envisioning for India going forward. I would say that, with the current account deficit, we do tend to see a lot of seasonality. So between one quarter and the next, the trends do tend to change quite a lot. So surplus in one quarter is not indicative of surplus going ahead. We do think we're going to slip back into a deficit of around 1.5% of GDP in the current quarter. The trade deficit for April-May has been fairly a fair bit larger than what we saw in April-May of last year. And that's partly on commodity prices being higher in this period as compared to the year-ago level. So while we are expecting this surplus to be transient, overall, we feel that the current account situation is very, very comfortable and is going to be a big part of India's macro stability going forward.
Okay. No, I take your point that fourth quarter is seasonal. Our exports normally do well because people are meeting deadlines, meeting targets, and we historically have been stronger in the fourth quarter. But Anubhuti, the same question to you, slightly tweaked. Yes, even the full year is a deficit actually, but it's only a deficit of 0.7%. That also is a historic low. We have normally averaged 2.5–3%. Can we at least say that going forward, India on a stable, sustainable basis will post a current account deficit at best of 1%, not more?
Yes, Lata, what you're pointing out is a very important structural change, which we can clearly call out for. So current account deficit, as you very rightly mentioned, used to be wide and extremely vulnerable to higher crude oil prices. With doubling of services exports, we have clearly seen a structural change in current account deficit story. And if I just break it down, just to give us a sense on how much financing requirements are there on an annual basis, effectively, our goods trade deficit gets completely funded by a services trade deficit and remittances. What is left to be funded is simply the payment which we have to make in terms of investments made in the debt segment or the equity segment. So, all the royalties, interest payments, dividends, etc. So that is the only portion which needs to be funded. So I would, definitely make this point strongly that the current account story has clearly seen a structural change, and from a thumb rule of where it is said that 2% of current account deficit is sustainable, probably, it will require oil prices to be extremely high to go to that level. Closer to 1% is the more likely scenario which we will see over next few years.
Okay. Well, actually, I know that Reserve Bank governors have in the past shared that for them it was a Lakshman Rekha not to cross 2.5%, because over 2.5% current account deficit to GDP, the pressures felt on the currency. But clearly at 1%, it becomes a non-problem going forward, as both of you ladies say. But Anubhuti, what about the rupee? Today itself, obviously, there isn't much movement because this is Jan-March data that we are getting, and that is priced in. But does this make for a stronger rupee going forward? What are your levels?
So in terms of our forecast, Lata, we are calling for 82.70 by end of 2024. So a little bit of strength coming from the current levels. Having said that, in India, current account deficit is a story which will persist. So any appreciation in our view is primarily driven by a temporary phase of, say, dollar weakness. We do not expect rupee to remain on a stronger footing on a medium-term basis. So I think if I have to draw a parallel to what happened in the last decade vis-a-vis what we expect this decade, if it was an expectation that rupee would depreciate by 2.5% to 3% on an annual basis, I think that range has clearly shifted lower by 100 basis points because of the structural change in the current account deficit story. Okay. So near term, by end of December, we might see a temporary period of rupee appreciation, primarily driven by dollar weakness when Fed starts cutting rate. But as we are a twin deficit economy, highly vulnerable to commodity prices, the depreciation pressure will remain, but it will be at a much slower pace than what we saw in the last decade.
You know, that's a big headline. If we were normally experiencing a 3 to 4% currency depreciation per year, and if that falls by 1 percentage point or falls to 1%, that's a significant change in terms of our risk-taking ability, our rating, etc. Aditi, would you agree, one, that we are in for a much slower depreciation, and two, will the Reserve Bank be the counterweight? You don't want an appreciation or a slower depreciation. You want a depreciation to beat the Chinese depreciation, to retain the advantage of the domestic economy, not getting flooded by cheap Chinese imports. So, two questions, track of the rupee and whether Reserve Bank will prevent the slower depreciation.
So, Lata, I'll offer you a few thoughts on these topics. First of all, as far as the rupee is concerned, in many periods, we haven't seen this average depreciation taking place every year. We've seen a movement in a narrow range, so a modest sort of a tendency to mildly depreciate. And then some event happens, either domestic or external, and you see a large step change coming through in the rupee. So firstly, this average, steady depreciation is something that we haven't seen in a long period of time. So step changes, what will trigger the next step change? I think that is something that, maybe it will be geopolitics in the current context, not necessarily a domestic reason that could lead to a step change in the rupee-dollar exchange rate. Secondly, I mean, if we look at our inflation differentials, certainly those now hopefully are going to be much narrower than what they've been in the past. So that supports what Anubhuti is saying as well, that even if we look at an average depreciation over a much longer period of time, it should be narrower than what we've been used to in the past, simply because inflation differentials should be much lower with the advanced economies than what we've had to deal with in the past. I would imagine that the RBI possibly will prefer to look at a more stable rupee. So, not too much appreciation and not too much depreciation. That's what we're expecting over the next few months.
Okay. Well, a current account deficit, current account surplus represents domestic savings going out. That's not healthy at our stage of growth. We are still, 120th in terms of per capita income at about $2,600 per capita. So do you think, Aditi, that the policy will have to work very hard to ensure that we have enough imports and our industry is able to absorb it? Should it become one of the policy focus to ensure we don't have a current account surplus?
So I don't think the current account surplus is here to stay. And certainly what has led to this, great deal of comfort that we got in the last few quarters on the current account side has been the inflows coming in from the services trade surplus, a lot of which is benefiting from the GCCs. And GCCs not only the earning us for an income, they're also creating a lot of jobs. So I think policy focus should be to support GCCs and make sure they flourish because they help us with our jobs question as well.
Anubhuti, what's your take? Would you say that since we have an impending surplus, or at least balance, not really surplus, should policy work very hard to ensure that we are able to absorb more imports? This is the best time we have under the sun, when the demographic dividend is kicking in, when tax to GDP is rising. Should there be a bigger effort to import more and ensure our industry is able to absorb it?
Lata, I think if we look at the whole focus of the government's policy, it is primarily focused on boosting the manufacturing sector. So when the push is to increase the medium-term growth prospects, I think an increase in imports will automatically happen. Not because the government wants the imports to be higher, it's just because the government is focused on boosting the medium-term potential. There will be counters to it, which can keep our current account deficit story on a more stable footing or at a level which doesn't put our macro stability under risk. The counter, as Aditi was pointing out, one is the services exports. India has clearly established itself in terms of GCC capability. And the other part is on FDI. I think this is one point which probably we are missing out when we are focused on the lot of positive news around the current account deficit story, is FDI has been slowing. If you look at the past 5 years, the first 3 years, the net FDI flow was closer to $40 billion. Then it came to $30 billion. And we are now down to $10 billion on net FDI for FY24. Current account deficit to FDI is a very, very important metric when you are looking at macro stability and also when you're looking at rupee stability. If the current account deficit gets fully funded by FDI, that provides a lot of comfort to the central bank that the reliance on less durable flows, that is portfolio investment, is not very high. Right now, I think even if we are at a $23-25 billion of current account deficit, it's giving us a lot of comfort. The FDI flows are not there. And our view is that probably when the interest rates globally move lower, this can emerge as a counter. Even if the current account deficit widens to some extent on increased imports, we can see some counter coming from the increased FDI inflows over a year and a half away from here onwards.
Absolutely. Anubhuti, I think that's a brilliant point, and we were actually flashing that data as well. One of the points I was making in terms of India not able to absorb imports, India's growth is wanting when the opportunity is coming knocking, is proven also by the fact that we have not been able to attract as much FDI as we should be in our stage of growth. As you pointed out, FDI this FY24 is 1/3 of what it was the year before, when it was $28 billion. So just a final point, Aditi, would you say that we are moving to a structurally different situation where the current account deficit may be there, but it will no longer be a binding constraint?
I do think so. I think we're in for an extended period where the current account deficit is going to, at worst, be 1.5 to 2% of GDP. And that also only if commodity prices skyrocket, perhaps because of geopolitical or other issues. I don't think the global growth outlook is going to be supportive of commodity prices being so high on a sustained basis that we get into a current account deficit at those levels. So I do think that structurally we're in for a very, comfortable period as far as our current account deficit is concerned.
All right. Ladies, thank you very much. There is, of course, the other big event that is upon us. On Friday, India enters the GBI EM bond index, and that will mean a regular flow of at least 2 billion into the Indian market by way of capital investments. So this is going to be a very important and a very liberating period in terms of India's external account, very far from the fragile 5 that we were just 11 years ago. So on that celebratory note, thank you very much, Anubhuti and Aditi. That's it on this edition of It's the Economy. Thanks for watching. Chartbusters coming up.